My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job, not just entertain, but educate, put days like today in context. Call me, 1-800-743-CNBC. Tweet me, @JimCramer. I'm always telling you that nobody ever made a dime panicking. Because the market does a very poor job of taking care of sellers who want to exit all at once. In fact, sellers who exit en masse get hurt.
The House of Pain.
Much worse than buyers who try to come in at the same time. Just like a rout at a stadium, if everyone tries to leave all at once, well, you know what happens. The asymmetry is well known to professional money managers, although that might surprise you, given how often these guys come on our air to foment panic. Hey, what's that about? I also like to remind you that even in the ugliest environments, good things can happen. And that's why it's important to know your stocks and know your companies. Otherwise, I know you're going to get swept away by your emotions, because that's the way people are. And if you let other people sway your emotions by their actions, you tend to sell at the bottom. Like last week when the billionaire bears came out all negative. And now you got no stock left when we have fabulous days like today where the averages explode. Dow gaining 565 points. S&P jumping 1.89%, NASDAQ rising 1.78%. Make no mistake about it, today was one extraordinary day, one that almost no one predicted. We looked at the Fed in the rearview mirror. We like what we saw. Chairman who knows he's got a winning hand on all the big inflationary points, and a Treasury auction, thank you, Josh Frost, schedule that could help create some equilibrium in the long end of the bond market, which is where we've been getting killed, and therefore that moved over and sent a tsunami toward our stocks. With that setup, Treasuries calmed down, long-term interest rates retreated, and for the first time in ages, what feels like mortgage rates could finally tick down. And that produced totally unexpected rallies in two groups that were just from Hades, the banks and the home builders, arguably the worst stocks out there in the last few weeks. And the ripple effect from strength in housing tended to reverberate throughout the rest of the market, including the pathetic retailers. Went from having a narrow rally earlier this week to a blockbuster broad one. But I don't want to overthink that. To me, this market's broadening out, but it's the strength of the earnings of the Magnificent Seven that stands out, because they were the ones that were really crushed last week when the selling was at its worst, and everybody I saw come on air, maybe you know someone who didn't, told us that these stocks were sales or shorts. Because many of these companies reported right into the earnings blast zone, their stocks got hit regardless of what they said. Remember, soaring rate backdrop caused us to look at the stocks as a losing asset class, and these stocks were therefore, by their own size, the biggest losers. Many of us have now worked their way all the way back, and then some, way off the ridiculous lows caused mostly by after-hour sellers who either were trying to knock the stocks down because they were short and they wanted to foment negativity, or they were just simply first-class idiots who didn't know anything. I want to go over their trajectories, each one by one, to show how much a mistake it would have been if you had sold with them and everybody was panicking. First, let's start with Amazon, which fell from 128 to 117 after it reported. Why did people sell? It's actually hard to even remember why they sold, because this was almost a perfect quarter. I think that some sold because Amazon Web Services was merely stabilizing and not accelerating. I told you that was ridiculous, that it was actually ready to accelerate. Amazon stock has come back when people realized, wait a minute, Web Services was stabilizing and ready to roar. I have no idea why the herd initially thought anything else was happening. Too many people wanted out at once. The downdraft in Amazon was caused by your panicked fellow shareholder who knew nothing. They knew nothing! Except to follow the herd, and now the stock is roaring well above where it was. Meta Platforms. It reported an amazing quarter, but people freaked out about one comment that advertisers were pausing their advertising because of the war in the Middle East. But if history's any guide, we knew that this would be a temporary pause. Sure enough, a few days later, Pinterest said they had the same problem, but the ad buyers are already back. Meta stock initially fell from $312 to $287, but it's now come back to $310. And we're no longer afraid of a slowdown in advertising. How about Alphabet? It missed on its Google Cloud. One line missed by $221 million. The stock fell from 138 to 122. It lost $221 billion in market capitalization on a $221 million miss. Makes sense to you? Not to me. Seemed extreme. No wonder the stock's come right back. I mean, it's actually doing very well, but they told the story in a sophomore prolix way. Too bad. Caused a lot of panic. Hire me. I'll do the call. Then you let me come back to the show. Tesla. This one's harder. Tesla missed like they all did in the electric vehicle business, but if they all miss and Tesla maintains its market share by cutting price, then the consumer will keep loving this brand, even if the margins won't be as good as they used to be, which is why the stock's coming back slowly but surely. Next, NVIDIA, falling from $493 to as low as $403. On what? AINWE. It's AI and then ENNUI. China orders out several years that our government's canceling. Well, yeah, that hurt it because, but you know what? There's so much demand for any of the chips that were canceled that were going to China that I think the company will be able to resell them in this country for higher prices. So it dropped more than 90 points because of potentially better sales and gross margins. And of course, yes, indeed, a terrible chart. Crazy. No wonder the stock's working its way back. I say own it, don't trade it. But you know what? I got in trouble for saying this before on Twitter or whatever. I said, look, if you want out, go ahead. That was then interpreted saying Jim Cramer says short NVIDIA. But you know what? I think that's funny. Only Microsoft didn't get hit as it reported an almost perfect quarter. Still, the stock lost $12 when the other mega caps got hit, and they got put through the meat grinder. That's $89.2 billion of market capitalization that declined on nothing. Nothing at all except collateral damage and the pull of a bunch of ETFs. I think it's safe to say that the sellers missed out on a real buying opportunity, and worse, they created the opportunity themselves to get in. Now, Apple reported after the close today. It's more of the same. It delivered a top and bottom line beat that nobody cared about. There was some hair on the quarter, more than I have on my head, so the stock initially got hit in after-hours trading and probably go down tomorrow. While iPhones are selling well, the personal computer business is awful. Though management said this should improve in the current quarter because of new product launches try to get them I have, I can't. However, the weakness in non-iPhone hardware was offset by the strength in Apple's service stream that nobody seems to care about because it's not tech. Up 16% year over year, much better than expected. I keep telling you the service stream is the future of the business. It will soon be worth more in revenue than everything else except the iPhone. Yet Macs, iPads, accessories, all added up will not be as big as the service stream. If we do get a meaningful pullback here, keep in mind what happened to the rest of the Magnificent Seven. Remember, my advice on Apple has always been own it, don't trade it. That's why I tell the club. Well, the two things you need to know. One is that there is absolutely nothing fundamentally wrong about growth, that you want growth in a company, but what you really want to do is growth by country. You have to take a look because India is coming on strong. Forget China. Think India is coming on strong. Oh, and those who laugh about the possibility of Vision Pro, and I hear the cackles all the time, listen to me, jokers. The first applications will be for businesses, not you. Everything from retailers trying to manage stores to healthcare workers trying to read screens. You'll think this thing's such a bargain if you're in the enterprise. This is the real deal. By the way, if you don't agree with me, shut up. There. I mean, I don't know. I'm trying to, like, you know, I have to keep it pithy tonight. Here's the bottom line. Days like today remind you that you can't panic and flee from the entire asset class just because everyone else is doing it. Even if you went out, which isn't necessarily the right thing, you're going to probably get a better opportunity when the crowd is done hitting the pavement. And that's it. So you say payment if you're from Philadelphia. You say pavement for the rest of the country. And that's especially true for the high-quality stocks that we call the Magnificent Seven. You know what? I feel like taking calls. Just something I have done for 19 years. Deborah in California. Deborah.
Hi, Cramer. Thank you for taking my call. I'm concerned about UPS stock. I've had a lot of it for over 20 years, and I don't know if it hold or sell.
Yeah, I have to tell you, I am equally as concerned. I do not think it's being run right. It did have a bad labor problem. So did the auto company, so I get that. But you know what? You know what the antidote is? FDX. Better company, lower valuation. Buy that. In case you needed a reminder, days like today show you that you can't flee from stocks just because everyone else seems to be fleeing. Sometimes they don't know anything, which is why I was using very pointed language at the top of the show, Mom. I'm sorry. Well, Man Money tonight. Are there big changes brewing at Starbucks? I'm sitting down with the coffee giant's new CEO, fresh off the earnings report, to go over the company's exciting new growth strategies. And yeah, this ginger chai. Then the beauty industry has been showing us the ugly side for most of the year. But could Elf Beauty, they add the F to the EL, they got something cooking? Could that be the outlier? I'm digging into the story with the company's top brass. And don't we all know it is football season? And that means we got to talk DraftKings. So I'm going to sit down with the CEO, see if it's the right time to buy the stock. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #Mad Tweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.